Our next topic is resident status. This is very important to determine the resident status because a UK resident person has to pay tax on all its worldwide income, while a non resident person has to pay tax on his income which is earned in UK. So, there are two automatic tests to determine the residential status. First is said to be automatic non UK resident test. If a person or individual stays in UK for less than 16 days or 46 days and has not been UK resident in any of the previous 3 tax years, or stays less than 46 days and has not been UK resident in any of the previous 3 tax years, and his stay is for less than 91 days and has works full time overseas. While automatic UK residency test, if the individual has stays in the UK for at least 183 days in the tax year, then he is said to be automatically resident person. Or her only home is in UK, means that individual has only one home and that is in UK. And third, if he works full time in the UK. However, it is possible that sometime the individual does not satisfy any of the automatic tests. In that case, he needs some sufficient ties test in order to be considered as resident or non-resident. There are 5 sufficient UK ties. First is said to be having close family member in UK. Close family member here means spouse or civil partner or minor child. Second, having accommodation in UK in which the individual spend at least one night during the tax year. Third, doing substantial work in UK means 120 hours work, at least 40 days working, at least 3 hours a day. Fourth, being in UK for more than 90 days during either of the previous 2 tax year. And last one, spending more time in UK rather than in any other country. So these are the 5 UK ties. And for this, this chart will explain how to determine their residential status. If a person stays from 65 to 16 to 45 days and he was previously resident, then he needs 4 UK ties in order to be considered as resident. But if he is not previously resident, then he is said to be automatically non-resident person. And if he stays in UK is between 46 to 90 days, then he is said to be resident if he has 3 or more UK ties and was previously resident, and if he was not previously resident, he needs 4 UK ties. For his stays, individual stays between 91 to 120 days and he was previously resident, he needs 2 UK ties, and if he was not previously resident, he needs 3 UK ties. And for stay between 121 to 182 days, if he was previously resident, he needs just 1 UK tie, and if he was not UK resident, he needs 2 UK tie in order to be determined as resident person. For counting of day, it is necessary that you understand that an individual is in the UK if she is in the UK at midnight. Now these are some questions. You need to check these. To determine the status of an individual as UK resident. Check and send me their answers. Next, our topic is saving income. Interest from National Saving and Investment Account. These include both NSI investment account and NSI direct saver account. Second, interest from gilt-edged securities or gilts, means government bonds such as treasury stock and exchequer stock. Third, interest from quoted company loan stock, also called company bonds, debentures, or loan stock. These are said to be investment income or saving income. Remember that income from NSI certificates and premium bond winning are exempt. Now about saving income nil rate band. If the non-saving income is zero, then 5,000 of saving income will be taxed at 0%. So first rule is saving income nil rate band. If your non-saving income is zero, then 5,000 of your saving income will be taxed at 0%. And if your non-saving income is, let's say for example, 1800, then up to 5,000 remaining 3200 of your saving income will be taxed at 0%, right? If your non-saving income is 1800, it means up to 5,000 there are remaining 3200 portion of income of saving income that can be taxed at 0%. So these are the saving income nil rate band rules with reference to non-saving income. Further, the rules based on total income. If total income lies in basic rate band, then further 1000 of your saving income will be taxed at 0%. And if your total income lies in higher rate band, then further 500 of saving income will be taxed at 0%. Now, for the application of these rules, test your understandings of Kaplan book chapter 3 will, all of these are very important. These cover all the scenarios. Now about dividend income. For the dividend income, the rate band are different. For the income up to 37,700, rate applied on dividend income is 7.5%. For higher rate band, the income between 37,701 to 1,50,000, rate band is 32.5%. And the income above 1,50,000, 38.1% rate should be applied. Remember that the dividend income saving nil rate band are very simple to understand. First 2,000 of dividend income will always be taxed at 0%. Individual saving account, the annual limit is 20,000 per person. Individual saving accounts are, remember, cash saving account as well as share and stock saving account. Then there is a married couple planning opportunities. There are 3 points in this regard. Married couple can transfer personal allowance between them, or they can elect to share income from joint property. Means if they have a joint property and one of the partner has lower income as compared to the other, then he can receive more from income from joint property, so that he will be taxed at lower rate. And the third and important point is transfer of capital asset. If a partner thinks that he already has income that will be taxed at higher rate or additional rate, and if he sold some capital assets, the capital gain will be taxed at higher rate, then he can transfer his capital asset to spouse in order to reduce his tax liability as a couple. If the spouse has lower income, or his or her income lies in a basic rate band. Here example is given, and that is about the investment income. Ting is married to Ning. She has employment income of 54,000 per annum. She has various bank accounts from which she receives interest of 5,625 each year. Ning earns 20,000 trading profit from self-employment. Each year he has no other income. Calculate the couple's income tax liability for the tax year 21-22 and advise how they could have saved tax by reorganizing their investment. To answer this, you have to calculate the tax in both cases. First, where no income is transferred between the spouses, and second, when he transfers his saving income to the other partner. So, if we won't transfer his income to the other partner, this is the calculation of Ting's income tax liability, and he has to pay tax of 11,082, while his other partner Nick has to pay tax of 1486. Now you have to consider the implication of transferring saving income. It is better to calculate again the whole thing, means the tax liability of Ting as well as Ning. In that way, you will better understand how much benefit he will get if he transfer the saving income to the other partner. Secondly, another topic from this chapter is said to be accrued income scheme. For this, I will show you two questions. You have to consider these two questions and identify what are the difference between them. So these are two questions. Number 13, where Menon purchased 2 lakh gilts paying interest at 1% for 2,11,000 on 1st September 2020. Interest is payable half yearly on 30th June and 31st December. He sold gilts on 1st December 21 for 2,13,000. How much will Menon include in saving income? This question. And the question number 15, where Ahmed purchased 10,000 gilts paying interest at 2% for 11,000 on 1st June 21. Interest is payable again half yearly on 31st March and 30th September. He sold the gilts on 29th of February for 11,400. How much will Ahmed include in saving income in respect of gilts in the tax year? Now stop this video and consider what are the difference in these two questions. What is the difference in information of these two questions, that you have to apply different method of calculation of interest. If you identify that difference, it is very good, but I will tell you what is the difference. In this question, Menon has already purchased these assets before the start of this tax year on 1st September 2020. While in this 15th question, Ahmed has purchased the shares or gilts in this particular year 21-22, and then sold again within this 21-22 tax year. So this is the difference in the information of question which suggests us to solve it differently.